Thank you for tuning into the Buyer's Guide podcast, where we talk all things property and finance. My name is Peter Mastriani, the founder of the Buyer's Guide, and in today's cast, we'll be discussing part two of our three-part series, which is focused on the overarching strategies involved within property investment, being passive, active, and alternative or emerging investment options. Now, following on from last week's discussion around passive investment, the focus will now shift to active property investment options. So, let's get to it. Development is an active approach to property investment as you're out in the market finding sites to do deals by turning them over quickly for a profit. This is in comparison to a passive property investment style of holding for a long period to achieve capital growth and also to reduce the overall debt position. Now, development does carry, quite a lot of risk, or there are a lot of associated risks towards development. So you need to firstly ascertain your actual risk profile to determine whether or not you actually have an appetite to pursue a venture such as this. Because for some, it may actually be better to pursue a safer, lower return investment strategy. So once you do that, the next thing is to really determine what strategy you're actually going to pursue and then ensure that you actually have the right structures wrapped around that strategy to work specifically for you. And doing so is going to impact on the overall tax payable on the profits that you do make or hopefully make. It's also going to impact on your ability to access that for private use, access the capital gains tax recessions as well, access to maybe losses made or even impact on your personal liability exposures. So it's very important that you focus on strategy because it will create tax efficiency, but it'll also mean that you don't get caught out. Because if you're doing something naughty and you end up getting caught out and get slugged with a 100k tax bill plus fines and interest because you maybe relied on misinformation or relied on a loophole that was probably or could be incorrectly applied, and if you're mid-development, this is going to create problems because not only will the banks be pissed, but your family will be worried, and the future of the project could, potentially end up on a knife's edge. There is liability issues as well. People do get sued, not often, but it certainly does happen. So those aspects are definitely worth being very mindful about. However, if you do feel that property development is going to be your pathway to success, there are several gates that you will need to pass through. Each of these has a potential for misstep, and property development isn't undertaken by the masses because I guess it could be overwhelming to a certain extent. Those that are not overwhelmed will certainly need a strong level of knowledge. They'll need to be doing some pretty slick research and planning. Otherwise, mistakes are going to definitely happen. With, I would suggest, maybe around about $200,000 worth of cash or equity, it's pretty reasonable to expect that you can get started within property development. Mind you, on top of this figure, you will also need an ongoing income for debt servicing. With that type of investment, though, you could invest into a syndicate or a joint venture, or undertake, your own small developments. Again, it depends on what intelligent and creative development strategies you can implement to increase your wealth position. Now, whatever strategy you do decide to pursue, there are going to be several main gates that you will need to proceed through. The first being advice and planning. So, get your house in order. Obtain some asset planning and strategic advice on the appropriate avenues to pursue. The next gate is obviously site acquisition. And finding investment grade sites is difficult. And if your strategy is to scroll through realestate.com.au listings, then you may have to find or determine a new approach. Good sites are increasingly becoming a rarity. Um, and they're extremely competitive. So, that initial sourcing part can be quite complex and time consuming. You do need to develop connections, negotiate on off-market transactions, prospect directly, and run suitable analysis on each opportunity before closing out on that deal. And you do need to be ready to act immediately when a suitable opportunity arises, because if you don't, someone else will, and that'll be another one that you will miss out on. A next stage that you will have to pass through is obviously development and planning. You need to have your specialist development team in place, which would include a project manager, and unless you plan to do that yourself, an architect, a town planner, an engineer, and so forth. Good accountant, good lawyer. You'll also have to pass through the development assessment, or the DA process. It'll need to be lodged and approved along with the building assessment, or the BA. Both are particularly detailed processes, and obviously you will require the associated specialist team around you. All going well, once you receive the green light on the DA and the BA, you can move towards construction. You can call for tenders, you can renovate it or detonate it, or maybe remove the existing dwelling, start the groundwork, start construction, and then you've got the ongoing management of that project. And then there's the after development. So looking at the sales, or perhaps the property management, depending if you're disposing or holding of the assets. You'll need to consider taxation, you'll need to understand your GST and your capital gains tax obligations as well. Again, you should have probably already covered this during the planning stage, and you may also need to take into account estate planning purposes as well. Now, property development can be a risky exercise, but those risks certainly can be mitigated, they can be reduced, and they can be managed. And they can be done by ensuring that your team has the essential experience and achievement that aligns with your strategy. Finding sites that suit the concept that you would like to implement, opposed to a concept that suits the site, could be a better avenue to pursue, because you could come unstuck pursuing a concept that you're not familiar with, or you could over leverage yourself as well. You just really need to ensure that you have a rock solid feasibility, and don't be afraid to maybe even fire someone if they're letting the team and the project down, because it's only going to impede on the results that you ultimately achieve. Also, buying property in the right zoning for your strategy is essential, because that way you really don't have to stress too much on not getting that development assessment through. So the more common developments that are undertaken are several, but there are a lot of creative and intelligent strategies that people do implement to generate wealth from an active property investment focus. Now, the strategy that they pursue will obviously depend on their own risk tolerances, their equity or their cash position. It'll also impact on their time and also resources available. And each strategy is going to vary in complexity and detail. Obviously, the higher the complexity, the more variables, and therefore the potential risk, which can offset the return. Now, the more common strategies do include a renovation or subdivision combined with a residential type development, whether that be sticking another house on the block or a granny flat or something like that, or maybe even remove the existing dwelling and build townhouses or units. Now, under these broad categories, there are several methods that can be applied to spin a profit or to manufacture equity and build wealth, which we'll now start discussing. So, if we're looking at things from a renovation perspective, the strategy has a lot going for it. Firstly, that there isn't a lot of barriers to entry. It can be, a relatively low risk process compared to, developing a set of townhouses, for example. So, on that rationale, the costs are more moderate, and timelines can certainly be um, expedited as well. Now, used as a strategy, renovation can, one, manufacture equity if you do intend to hold that property, and secondly, you could flip it in terms of buying, renovating it, and then on selling it as well. They're probably two of the more common strategies implemented if you do decide to move down a renovation path. Now, if your intention is to buy and hold the property, then a strategic renovation could be an excellent strategy to apply. Done right, rental yields could certainly increase, and equity in the dwelling should increase, which you can put to use to fund the purchase perhaps of another investment. Now, some important considerations to apply through your planning process is thinking about the structural integrity of the property. You'll need to think of approvals that may be required. Um, you'll have to think about whether or not the renovation will appeal to a broad base of potential renters or potential buyers. Are the renovations actually adding value to the property without overcapitalizing? If it's a unit or a townhouse, will there be body corporate issues that or special terms or conditions that will be applicable? And how are you going to finance the modifications, or what tax advantages, including depreciation, could be applied? How long will it take? Does the cash flow that you actually have support the renovations and that period of vacancy as well? So there are some important considerations, along with many others, that need to be given some considerable thought before moving down this venture. Now, an increasingly popular option is to build equity and improve cash flow is to actually build a granny flat. Now, obviously, this would be a suitable option for a detached dwelling. I think it would be hard pressed to get a body corporate to approve that one to sit in the back garden. However, a granny flat that is flat packed can be a relatively inexpensive process and built very quickly. Demountables or dongers, as commonly referred to in the mining industry, could make a great prefabricated home in the backyard. Pending planning approvals, of course, you can actually pick up some flat packs out of China for less than $10,000, or source it domestically for around about $80,000 and up. Installation and build costs are on top of that as well. Now, as a property investor, granny flats can allow you to earn higher or multiple incomes from that one property, which can sometimes be enough to turn a negatively geared property into a positively geared one, for example. And from a renter's perspective, though, it may not be for everyone. Some may be displeased to be sharing the property with a potential stranger. Alternatively, it could be the perfect option for a larger family, or for one that requires alternative living arrangements. Now, flipping is definitely commonplace. If you watch Channel 94, you'll see any number of shows, particularly out of North America. And look, arguably, I should say, flippers would be, pretty readily available compared to, finding investment grade development sites. Again, it is a lower risk, and moderate capital injections are going to be required, which does make it more appealing for individuals to make a start in pursuing an active investment strategy. Also, you don't necessarily have to worry about obtaining development assessments or building approvals or going through long protracted council approval processes, unless of course you're undertaking major structural changes and extensions. Now, the risks associated with flipping properties do center on time due to the holding costs and maybe even missing the mark. because you've maybe overcapitalized or um, overpaid for that property initially, not properly identifying the demographics of the region, or perhaps you've just had poor timing. And the list can go on for any other number of reasons. Now, cash flow considerations and accurate projections or forecasts do need to be maintained to ensure that you do achieve a profitable outcome. Again, obtaining any necessary approvals and meeting regulations, are an absolute must. But purchasing and selling and taxes should also be considered when buying and selling a property. So, the actual costs associated with this process can be quite high. But by sticking to a few rules, you should be able to secure, a profit, and that can be done by buying below market value. Um, you can upgrade and style really fast. The dwelling needs to obviously have street appeal, along with nice big ticket items such as a good family kitchen and good family bathroom. Um, Having to do anything structural can really blow out your costs. So at times it can be better to stick with existing layouts. But a new paint job, a new carpet, tiles, or polishing the floors, adding new blinds or curtains or fittings and fixtures can really have a dramatic cosmetic improvement to the overall property, which is really what you're after. Um, a lot of properties in this flipper type range are within the low to medium end of the market, because there is a larger pool of buyers to target. Secondly, it's less risky due to the capital outlay as well. But again, it's a competitive buyers market within that space where you're competing with other investors who may be looking to purchase property through their self-managed superannuation funds, or baby boomers looking for a new rental as a property investment, or even first home buyers getting into that 400 to 600,000, $650,000 price range. I think most importantly, though, it's really important to be realistic with your numbers and have conservative figures. Are always going to be best in these circumstances. So you need to maintain a budget and cash flow statements and really focus on your numbers. Now, the next thing that we'll discuss is subdivision. Subdivision, again, is a pretty common strategy that's employed by people that pursue a active property investment strategy. And subdivision does carry, a lot more complexity in comparison to, undertaking a strategic renovation, and that's because there are more risks and a longer time frame that's involved. But the rewards are potentially going to be greater as well. Now, if you are planning on utilizing subdivision as a strategy, you will need to proceed through around about 5 distinct stages. That being the advice and planning stage, the site acquisition, the development and planning stage, construction, and then post-development procedures. Now, very broadly, these will be gates that you will need to proceed through during the subdivision process, and like all things, variances will occur. Now, two main subdivision strategies are most commonly applied. One being that you acquire the site, you strip it or remove the existing dwelling to one portion of the block. Then you obtain the DA for a concept development, and you either decide to flog it off to someone else to complete the construction, or you can acquire the site, move the existing dwelling or clear the block, obtain approval, develop, sell, and or hold the new assets. Now, numerous activities can take place between these two options, and the variations largely sit in and around construction, and also the planning and development stage and that approvals process, depending on what needs to be done to the block to get it through that council process. Again, obviously this is going to be defined by your ultimate strategy and the concept and planning and the site requirements that are going to coexist. Now, legislation and rules do vary considerably from state to state and council to council across Australia. So, it's really important to consult with planning experts with expertise in that specific location that you're actually looking at doing the subdivision in. Now, for a generic overview of the subdivision process, the steps are acquisition, where you would go and do your due diligence and your research and planning and your purchase. The next being the planning and approvals, where you'd lodge the DA, you get the DA processed, and you have the application decision notice that would come through. The site prep is the third distinct stage, where operational works do commence along with other building activities. Next is that you obtain quotes and contracts, where you source builders and the trades and agree on contracts. Next is construction, so it's build stage, it's the project starts to finally take shape. And then is completion, where you get the plan sealed and the title registered, and then you look to offload those assets or hold them or do whatever it is that you intend to do. Now, if you do own the property and it fulfills the existing criteria listed above, you're going to be off to a really good start. Alternatively, you will need